Cisco just banked a massive $9.3 billion in AI orders, and the market responded by violently throwing the stock around in after-hours trading. Welcome to Earnings Unscripted. It's August 12th, 2026, and we're unpacking Cisco's fourth quarter, ticker CSCO. Miro, that extended tape was absolute chaos.
Total whiplash. It spikes right after the bell, then completely cratered going into the earnings call, before finally drifting to a small drop from the regular close. The street just struggled to price this print. Revenue hit $17.3 billion, up roughly 18% from last year, so structurally a really solid top-line beat.
Right, and non-GAAP earnings hit $1.22 a share, also up nicely. Plus, they had these fascinating little operational moments on the call. Chuck Robbins said they ran a massive mountain of internal IT support cases using their proprietary AI assistant. Zero human intervention for the whole year. Meanwhile, I can't even get my laptop to talk to the studio monitor.
Right, well, that's the dream. But looking at the market's actual panic attack yesterday, and just to put it out there, we're simply sharing our own read on the tape here. Please don't use this as financial advice. But look, the core anxiety points straight to their product mix. Their networking segment surged, but selling those heavy AI racks structurally crushes their product gross margins.
Okay, wait, so the more of these new AI boxes they ship to the hyperscalers, the worse their margin looks?
In the short term, yes. They require incredibly expensive memory components, and memory costs are spiking, so the physical hardware profitability takes a hit. The trade-off's that they don't have to hire additional sales reps to move those units, so their operating leverage actually absorbs the blow, pushing their final operating margin up anyway.
It's Costco rotisserie chicken dynamics for enterprise tech. Take the hit on the physical unit because the operational scale makes it rain cash. But what I don't quite get is the timeline here. If they have this unbelievable order backlog banked today, why are their revenue forecasts for next year so much smaller? Where are these deployments actually getting jammed up?
It's the nature of hyperscaler accounting. When these massive cloud providers place an order for AI infrastructure, they aren't buying off the rack for next Tuesday. They secure capacity years in advance.
Okay, so it's essentially layaway for cloud giants. They claim their spot in line today, but Cisco can't actually recognize the cash until the hardware is physically deployed in a data center somewhere?
Exactly. Mark Patterson specifically called these deployments significantly non-linear. You've got this gigantic backlog sitting there, but they're projecting that conservative, much lower revenue target for the fiscal year just because the deployment timelines are incredibly spread out. Plus, they're up against some brutal year-over-year comparables from when they were in hypergrowth.
Right, because last year was such an anomaly. So it's not that the underlying demand is evaporating, it's just a traffic jam at the deployment phase.
Yeah, and frankly, that lag gives them time to solve the margin problem we flagged earlier. Remember how the heavy memory costs are currently pressuring their physical box profitability?
Yeah, the rotisserie chicken dynamic. They're taking a margin hit on the unit to gain the operational scale.
Right, except they aren't just sitting there absorbing it passively. Chuck Robbins highlighted this internal group called the G2 team. Instead of just blindly passing all those component costs onto the customer across the board, they ran dozens of internal engineering programs specifically to reduce the memory footprint inside their own hardware.
Wait, I'm sorry, you can just do that? I always thought of a network switch as this fixed physical box. You can't just politely ask it to use less memory.
You can if you're willing to completely rewrite the firmware and optimize the silicone logic. In one specific case, they slashed the memory requirements for their new Wi-Fi tech by 50% in barely 3 months. It's a pure engineering solution to a macroeconomic supply chain problem.
Okay, that's genuinely impressive. Because usually when costs spike, a legacy tech company just jacks up the enterprise software subscription price to cover the spread.
Well, they did raise some prices too, to be fair, but listen to how Patterson framed the philosophy behind it. He said, the prices increases that we do are specific to hardware driven towards those products that have a higher level of memory utilization, so that we really try to zero in on where the pain is.
Oh, okay. So it's a surgical price hike. They're only taxing the customers who absolutely demand the heavy, memory-intensive rigs.
Exactly. But here's the detail that really caught my attention. The most revealing part of the call wasn't the pricing strategy. It was a throwaway comment about how they're handling their underlying silicon supply. Patterson casually mentioned that he and Chuck are physically traveling to engage directly with TSMC.
TSMC? The mega foundry in Taiwan? But wait, doesn't Cisco usually buy their finalized chips from a merchant middleman? You know, someone who designs the networking silicon for them.
Yes, traditionally. But they're actively breaking that chain for their AI infrastructure. They're going straight to the absolute source. They're dealing directly with TSMC for the wafer substrates, the packaging, everything. Patterson actually said, we're not waiting on any sort of allocation and commits and decommits, if you will, from any merchant silicon providers.
Wow. They're just entirely opting out of the traditional allocation downs.
Yeah, they're pulling the physical delivery chain under their own roof. It secures the immediate supply for those massive hyperscaler orders, and long-term, it prevents those standard merchant silicon players from stacking margin fees on top of Cisco's base costs.
It's a massive flex of scale. Not many companies can just knock on TSMC's front door and demand direct foundry capacity. So if they're physically re-engineering their hardware and completely circumventing the traditional chip brokers, what does that level of aggressive operational pivoting actually cost them?
It cost them roughly $1 billion. They're absorbing a massive pre-tax restructuring charge this year to fund the pivot into silicon and optics. You don't rewrite your entire supply chain for free, but management feels incredibly confident that it pays off soon.
Right. Sure. They sound confident, but did they actually put guidance to that? Because the after-hours chart suggests the street's pretty divided on what to believe here.
They did. For their upcoming first quarter, they guided total revenue between $18 and $18.2 billion, and they're targeting healthy EPS growth for the full year. So the model's holding up.
Okay, but that's slightly weird, right? Because they have that enormous AI backlog we mentioned earlier. I mean, why isn't that translating into a massive short-term revenue explosion?
That's exactly what analysts were pressing them on. They only expect to recognize roughly $7.5 billion in AI infrastructure revenue for all of next year. So it's deliberately conservative because the deployment timeline's incredibly stretched out. Plus, they're facing some brutal year-over-year comps now.
Right. It's just delayed gratification. Though there's this one weird catalyst that I love, the last day of support panic. Everyone's suddenly realizing their legacy networking gear's completely defenseless against these new zero-day hacks.
Oh, right, the LDOS cliff.
Exactly. So they're pulling emergency cash from their cybersecurity budgets just to rapidly upgrade standard Cisco hardware. It's basically a stealth refresh cycle.
Yeah, Robbins actually mentioned that on the call. Some factory CEO finds out an old switch on the floor can't take the latest security patches, and they just rip it out. It's masking regular infrastructure sales under cyber panic spending.
I can't even blame them. That's just brilliant enterprise selling. But it definitely means they've got a lot of moving parts to juggle right now between the direct foundry deals, the new memory specs, and managing this panic buying.
It's a heavy lift for sure. We'll have to see if they can maintain that operating leverage next quarter when those new low-memory hardware units actually hit the market. That's the real tell.
Absolutely. We'll just have to watch how that massive backlog actually translates into shipments. I think that covers the big questions for this print.
Always a pleasure. See you next time.
If you had fun hanging out with us, consider tapping that follow button so our next episode is just waiting in your feed. And speaking of zero human automation, like we saw with Cisco today, it's the perfect moment to share that this whole show, including our voices, is a fully synthetic AI experiment designed to turn same-day earnings calls into natural conversations. We'd absolutely love to know what tickers you want us to tackle next, so reach out at earningsunscripted@datamadness.ca or grab the X link in the show notes. Have a great day.
Catch you later.